Hello, everyone. Lisa Crosta here with Crescent Harbor Private Wealth. We're doing another series in our Crescent Connections. And today I have with me Jim King, a partner at Aprio Advisory Group and the co-leader of Northeast Real Estate Division. Today, we're going to talk about 1031s, which are like-kind exchanges in the real estate world, and we'll explain them better shortly. But they're a great tool for preserving wealth, mitigating taxes, estate planning. You'll hear all different avenues. Jim uses these a lot in his business or sees these a lot in his business. So we'll talk through some stories as well. So welcome, Jim. How are you today?
I'm doing fine. Thanks for having me. I'm excited about this topic. It always gets me up and going. It's one of the
Yep.
more interesting topics in our tax world.
Yep. And we can save people taxes. You can't complain about that, right?
No, not at all. Not at all.
So let's kick it off with what is a 1031 exchange?
Okay, a 1031 exchange, also known as a swap, also known as a like-kind exchange, is a vehicle where you go ahead and instead of paying taxes on the sale of property held for investment, you swap out. And what's pretty cool about it is you can go from one property to three to one. You can swap out land for non-residential property. You can swap out residential for land and non-residential. But it's a mechanism where you're essentially pushing the can down the road as far as deferring the taxes. So in real estate, like you and I spoke about, we don't like to pay taxes in real estate. This is one of the vehicles that helps us do that.
Right. So rather than selling a building for $5 million, paying taxes on the, in my example, $2 million gain, then only having some money of that $5 million left to reinvest, you use the whole $5 million, buy a new property, and the taxes that you would have paid just get pushed into the next property.
It gets pushed into the next property. You've saved money. So there's additional monies that are left because you now don't have to pay your federal and state taxes as well.
Right.
So correct.
Right.
Yes.
Yep. Excellent. So what type of property qualifies? And the question I get the most is, can I do it with my primary home?
No.
Okay. Too good to be true.
No, unfortunately, you cannot do it with your primary residence. The other one that comes up a lot is partnership interest. So a lot of real estate investors own property inside LLCs, but you cannot swap LLCs. You cannot swap one LLC for another. You have to swap out investment property. So one piece of investment property for another. That's the main qualification.
Okay. And we said it doesn't eliminate taxes forever, but it pushes it way down the line. It could be forever, depending on what you die with, but we'll get to that. Do you have any access to any money at the time? Like, say you want to get some money out, but you want to roll, 80% of it to a new property, but you need some cash for other things. Can you do that?
You can do that. There's one strategy around it. One of the things you can do is you can take cash out. That's referred to as boot. When you take boot out, you have a capital gain and then would have to pay tax on that. But the important aspect here is just pulling some cash out doesn't prevent you from doing the overall exchange. So understand, if you walk away with any money in your pocket, you're going to be taxed. One of the things we've seen is after the fact, you can always refi. So I buy a piece of property and, you and I ever talking about real estate, we're constantly going to be talking about refinancing, right? Because that's the strategy. So after you've had it and there's some growth in the value, refi and take the money out.
Right. So talk about, I know there's a lot of little, I'm going to call them nitpicky rules about the timing to do this. Somebody can't call you after they already sold a property and they're shopping around, taking their time. There's rules you have to follow to be able to push these taxes down. So let's go through some of those rules, the 45-day, the 180.
Yep, sure. So the first thing to keep in mind is that if you sell a piece of property, you have to use a qualified intermediary. Okay, so one of the reasons why it's tax deferred is you don't put your hands on the cash. So that was what the old case that started this, Starker. That's what it allowed you to do. If you don't touch the cash, you're good. Okay, in the simplest terms. So I sell a piece of property and it goes into a qualified intermediary. Think of it as a trust account.
Right.
I have 45 days to find replacement property or properties. Okay. And then within that 45 days, I have 45 days to identify property. And then I have 180 days from the sale of the relinquished property to buy replacement property. So just to go over that, I sell a piece of property. I have 45 days to identify replacement property. I have 180 days to find the replacement property and close on it.
Right. And the intermediary holds that, the qualified intermediary holds that money in between.
That is
There's
correct.
any money to hold, right? Okay.
Yeah.
And some of the more common mistakes that you see, I mean, obviously people come to you too late, right? 45 days, maybe they come to you on the 44th day, but other mistakes that you see people make that maybe they
Yeah.
don't think of?
The one is they come after they sold the property, right? And then there's really nothing we can do.
Yeah.
The other mistake is there's an interplay between debt and cash. So we have what we call a rule of thumb, which is you spend the cash and you replace the debt. So if I have a piece of property that has $200,000 worth of debt on it, I have to buy another piece of property with at least $200,000 of debt on it. I can put more on,
Okay.
and I can replace that debt with cash. Now,
Okay.
what's important here is I can't do it the other way. So if I receive a $500,000 of cash, I can't go buy another property for $400,000 of debt and $100,000 of cash. That's what happened, right? I walked away with money in my pocket. So
right.
you can replace debt with cash. You can't replace cash with debt,
which would be like pulling money out and getting it tax-free, which you can't do.
Exactly.
Right.
Yes.
What's the rules about, these are all investment properties. So we said we can't use your primary home. Does it matter if it's rental real estate or commercial real estate? Are there any rules about the type that makes it not be like kind? Because 1031 is a like kind exchange, right?
No. And that's one of the more best things about the like kind exchange rules is if I had a piece of land and I was looking to change my portfolio because I needed more income producing assets and I was holding a piece of land for investment, I can sell that land in a like kind exchange and roll into a residential property or maybe a strip mall, a combination of mixed use property. And then that thereby allows me to start, changing my character and I start to get income coming in, which I didn't have in the land.
The first one.
So that's a great tool to, diversify your portfolio a little bit.
Right. That's good. Let me just look. I want to make sure there's a little couple questions. So tell me some good stories about how you've used this effectively with some families of when it tied in estate planning, because real estate is tough to plan for the next generation, right? It's hard to split. It's the what's it worth and who wants to run it and who doesn't. So how do we use these 1031s to do some smart estate planning?
Okay, so as you're aware, we're all aware of the great wealth transfer that's coming down. The big number here is about $2.5 trillion of U.S. real estate that's going to exchange hands over the next 20 to 30 years. Right. So the key here is from an estate planning strategy, how are we doing that without incurring any income taxes or reducing your estate taxes? One of the ways that we see is the utilization of DSTs. And I want to jump into that. I know we were going to talk about that a little bit.
It was only one question down. We're good.
Okay, good. So what is a DST? A DST is a Delaware statutory trust. It is a vehicle that allows you to own a piece of property. And what's fantastic about it, and as it ties into the estate planning, is I have a taxpayer. He owns 10, 15, $20 million of real estate. He made all of his fortune in real estate, and his children want nothing to do with real estate, nor do they understand anything about real estate.
Right.
But he wants to keep real estate in the family. So we've seen this a lot. So what happens is he owns all these types of properties that he has to manage. He's getting up in age. So he wants to transfer into a passive type of investment. And that's what one of the things with the DST is. It's a passive investment because there's a sponsor that comes out, purchases a property and sells DST interest, which are beneficial interest in that property. So if I have a commercial building, I can sell that property, roll into the DST in a like-kind exchange, pay no tax. Now I've diversified all my active business, all my active real estate into passive investments. And that's a great tool from an estate planning perspective.
And we see it because just the reason you said, people want to pass the assets on, but the kids don't want those assets. And we see, how do you split a building in 3 and nobody lives there? And so now you can take this investment. I mean, I say to my clients, it's really like It's like owning a piece of it's like owning a stock or a mutual fund, a share of something that can then be divided up. And then when you die, you get to step up in cost basis.
Okay, so now you're right. This is the ending. This is the
Yep.
ending of the story here, right? So let's walk the line a little bit here
Yeah.
of real estate investments. I buy a piece of property, I refinance it. I wait a year or two, it grows. I buy a piece of property, I refinance it. I sell that property, and I roll into another property or properties. Okay. And I keep doing that. And that's what the real estate guys that are very successful do. They roll into larger. So I go from one property into two, maybe into a strip mall, maybe into a mixed use property. And I keep refinancing and taking money out and generating losses, which I want to come back to in a second. And then what happens? At some point, you're going to have to pay the price, right? And pay the tax, unless you hold it till death, right? And death is the best part about the real estate planning. I know this sounds very morbid. So what happens at death is all of this money that I've taken out, now I've generated what's called negative capital if it's held in an LLC. All of that gets stepped up to fair market value. So then upon my death, when those assets transfer over to my heirs, they are receiving it at fair market value. So that's the ultimate play. But I want to take a step back in when it goes to real estate. So two things in real estate. When you buy a piece of real estate, you always have to think about what a cost segregation study is. Okay. So a cost segregation study is you come in and you depreciate the building at a quicker pace. Now with the new tax law, what has happened is that quicker pace becomes a direct write-off right now.
Right.
So rule of thumb, we have a $1 million property. I do a cost seg on it. The general is somewhere around 25%, depending upon the nature of the property. I get to write off 25% of that $1 million, okay, into a shorter life, and then I bonus that, right? That's the key. So now I have $250,000 of losses that potentially, depending upon other limitations, could be used against your income.
Right.
And then on the sell side, that's the other part that we've been talking about, since we started here, is the 1031, right? So when you buy a property, you think of cost segregation. When you sell it, you think of, like-kind exchanges.
Right. Excellent. And nobody ever pays any taxes.
never pay taxes.
The step up in basis is incredibly powerful all throughout the investment world. That.
Yeah, 100%. Can we go back to the DSTs a little bit?
Yes, for sure.
Okay. So the DSTs, the other way that we see it, aside from the estate planning, is what we refer to as boot mitigation, and you alluded to that earlier in the beginning. So what does that mean? So in your scenario, I sell a $10 million property, and I can only find an $8 million replacement property.
Okay.
So therefore, normally I could take the $2 million out, like we discussed, and that would be boot. But instead of paying boot, I go buy a DST for $2 million. So now I can go ahead and complete my exchange in full, pay no tax. One of the other benefits about the DST is you can get into one in 3 to 5 days, 5 to 7. They're that, they're that available nowadays. So, and it's also good to use DSTs to identify properties in case you run into this or in case something falls through. So you can always complete your exchange. Right.
That's a good piece of advice. Yeah. Excellent. I forgot about that you could split it up and use, and then the cost basis is just allocated, right? Like I assume it's a pro rata allocation. If you put $2 million in and you bought a property for $8 million, they'd allocate the cost basis into the two.
Into two properties.
Yeah.
And if you go into a DST and you go ahead and trade up, meaning I sell a property for $10 million and then I go buy a replacement property for $12 million, either debt or cash, it doesn't matter. Now I have $2 million of what we refer to as excess basis. I could potentially take the cost seg on that excess and depreciate that as well too.
Interesting. Okay. All sorts of stuff.
All good stuff, right? That's why we're here.
All planning stuff, right? No, exactly. It is. And I feel like we're seeing these, or maybe we're just having these conversations more and more. It's, also the market's up so much around here. It's been up so much. There's so much built-in gain all over the place that people are looking for ways to, not pay taxes, at least not today.
Right. The like-kind exchanges have been around for a long time, but to your point, the DSTs are just getting popular within the last 4 or 5 years. If you go back 5 or 6 years, maybe there were a handful of sponsors. Now a lot there's a lot of sponsors and a lot of opportunity to get into this type of property.
Yeah, I see them at conferences I go to. They'll have tables set up and stuff. I definitely see more of them than I used to.
Yes, absolutely.
So, I mean, you sort of said this, but investors ever thinking of selling, when should they bring in their accountant and their advisory team?
Well before they decide to sit, well before they decide to sell.
Right.
You know, and one of the things we're going to talk to them about is, you know, what is their long-term strategy, right? If they come in and say, hey, I want to sell a building, that by itself is, you know, you and I would sit with them and we need to understand that a little bit more. You know, what else do you have? What is your strategy? What is your exit strategy? You know, do you own it with partners? Do you want to, you know, leave it to your children? Do you want to leave it to your grandchildren? Do we want to roll into something passive like a DST?
Yeah.
So the best thing to do is when you're considering it, you know, contact you know, yourself or me, and we can certainly help them in that regard.
Right. Any other good, not to put you on the spot, but any other good stories that are interesting that maybe something went a different way than you thought it was going to be, or we have a little time, so you could share?
Yeah, there's one that's very interesting. So
okay.
At DST, I was called in with two families that owned a property, an $8 million property in New York City. And the families did not speak with each other, which was interesting. And from a tax perspective, it was held in a C Corp, which you never do. So it's been in the family for years. One of the reasons you don't hold it in a C Corp is you wind up paying double taxation. So when you look at double taxation, you look at the city tax, and you look at all these other taxes, the effective tax rate on the sale of this $8 million property was close to 70%, which is insane. So that actually forced everybody to come to the table. And then we devised a plan, which was, okay, we're inside the C Corp. And what we did was we sold the property in a like-kind exchange, because there is a same taxpayer rule. The taxpayer that sells the property has to be the one to replace it. So inside the C Corp sold that property and then replaced it with two separate DSTs. One DST, which is one side of the family picked, the other DST, which the other side. So each family did not have to continue to talk to each other. All they had to do was, you know, manage those properties that they picked. And then there's additional tax planning that came into play. We made an S Corp election, and then we'll talk about liquidating down the road. But you know, that's the power of like-kind exchanges and DSTs. It allows you to be, you know, real creative, which is what we like.
And I want to go back to something you said before about the LLC. A lot of clients of ours hold, they may have a few investment properties or rental real estate, and they hold them in LLCs. They can trade within the LLC. They just can't mix from Tom and Joe LLC to Mary and Lou's LLC, right?
That is correct. But one really good way around it is the structure that a lot of real estate people have when holding real estate. And whether you own 3 pieces of real estate or 300, the structure is relatively the same. So if you think of a holding company on top, and that's owned by, we'll say, husband and wife, that holding company owns a single member LLC, a 100% owned LLC of the land and the building, whatever that piece of property is. And then you continually move over. And you know, we tell our clients, just name those LLCs the address so you can keep track of the recording. So you'd have 123 Main Street LLC, you have 56 State Street LLC, so on and so forth. So what happens inside that, you're only filing one return. Since they all are owned by single member LLCs, you're limiting any sort of liability to that. You have one slip and fall on property A, it's not going to affect the rest. So that is a structure that we like to use. What we also do with that structure is we set up a management company on the side that provides management services to those. And at first blush, it looks like, okay, if I own all of this and I'm paying from one company to the other, it's netting to zero. But what we've done is we've created we've changed the character of the income. And the primary focus of that is to be able to fund pensions at the management company level. So it's a good tool. And then you can think about, putting some family members to work and put family members on the payroll, things of that nature at the management company.
So again, I'm just going to say it so everybody got it. So top structure is the big holding company that owns all the individual LLCs. And we want individual LLCs because it protects the liability at each location separately, but they're single members. So they all roll up to this holding company, and that holding company can make exchanges inside of it. easily.
Right. And that's a really good point to point out. And the other piece that it can do is from an estate planning standpoint. So if you have a husband and wife up top that own
Hmm.
this, now they want to start gifting some of their assets to their young to their children. And we
Hmm.
know real estate is always at the top of the list of consideration for gifting and
Right.
estate planning because it has the most potential for
Yeah.
growth.
Yeah.
Right. So you gift it now and all the growth comes out of your estate. All you have to do is gift an interest in the holding company. So you're filing one gift tax return
Mm.
as opposed to, oh, I want to give them a piece of this property, and then you got to do a valuation on that. I want to give them a piece of
Yeah.
this property, so on and so forth. So it's good from an efficiency standpoint as well.
Yeah. That's a nice plan. I got to remember that. Okay. Well, I like to keep these, right around 25, 30 minutes. More people watch them that way. So
Okay,
this was
good to know.
a great amount of information, super useful. And in this area, we see so many people doing real estate transactions. So I hope you enjoyed the chat with Jim and I. You can find me at Crescent Harbor Private Wealth and Jim at Aprio. Anything else you want to add, Jim?
No, I just want to say thank you again. This was exciting and fun, and I look forward to talking to you about this stuff more.
Excellent. Thank you.